Hello and welcome to our variance analysis practice exercise. So with this exercise, we're going to be going through standard costing, which is basically a budget on a per unit basis, and variance analysis is the kind of the end result there. The entire purpose of standard costing is to give us some amount that we expect the cost to be and compare it to our actual costs to determine what sort of variance we have. So I've built this template which should help you to work really any type of variance analysis problem that you might have related to the materials, direct labor, and variable overhead variances. Now the fixed overhead variance is separate. I wanted to mention that. That's a separate calculation altogether that we'll deal with in another journal entry or another practice exercise. But this particular template will work fine for the first three. So let's take a look at our information here. We have quite a bit of information, and I've set up a template to show you a couple of different alternatives depending on what the textbook problem is giving you. So in this case, the company has manufactured 20,000 units using 143,000 square feet of materials, whatever it happens to be. It was purchased at $130 per square foot. This required 400 direct labor hours that cost $16 per hour. We're going to come back to all this, by the way. The standard for production is 7 square feet per unit at a standard cost of $1.35 per square foot. The labor standard is currently set at 0.028 direct labor hours per unit at a standard cost of $15 per hour. The variable overhead standard is set at $8 per hour. However, actual variable overhead was $4,100. So some of this they're giving you on a per unit basis, some they're giving you in total, and I've done that intentionally to show you down below how to handle both alternatives. Now we do have fixed overhead that was originally budgeted at $4,200 for the period, but it ended up being $3,900. It's applied on the basis of direct labor hours, calculated by dividing expected total overhead by the expected number of total direct labor hours. So let's take a look first of all at what these variances are. Whether we're talking about materials, labor, or variable overhead, it basically boils down to two types of variances. Different textbooks give them different names, but it's essentially some sort of price variance and some sort of quantity variance. The price variance for materials, it's often referred to as the price variance. For labor, sometimes it's called the rate variance. And for overhead, sometimes it's called the spending variance, or even the efficiency, or I'm sorry, the spending variance for that one. But what it boils down to is price. Price per some sort of unit, whether it be a pound of material, an hour of labor, or whatever. The quantity variance is basically the difference in our quantities multiplied by some price. So this has a different name as well. For the labor and overhead, they sometimes call it the efficiency variance or the usage variance, but it boils down to being some sort of quantity variance. So we're going to have two items. We're going to have prices and quantities. Now, each one has an actual and a standard amount. But first of all, let's look at the actual formula. The price variance is going to be the difference between the two prices, actual price and standard price, for 1 unit of input. 1 pound of material, 1 hour of labor. It's not the difference in the price we've paid for everything altogether. It's the difference in the price for 1 pound or 1 hour or 1 square foot, as in this case. Just one of those units, regardless of how many pounds or square feet a full unit of product takes. We're looking at the price for 1 square foot of materials. Now, the difference in the two prices has to be multiplied by some sort of quantity for this to become an overall variance. It's the actual quantity that's used. Now, the actual quantity in this case is not just for 1 unit. It's the quantity of those inputs for all of the units you've actually produced in total. So how many square feet did we actually use for our entire production? Not just to produce one unit, the entire production. And keep in mind it's actual quantity. So just to repeat that, the prices, whether they're inside of the brackets, as in the price variance, or outside of the brackets, as in the quantity variance, the price is always going to be the price for 1 square foot of materials in our example. The quantity is always going to be the quantity either actually used or expected to be used down here for our entire production that we did indeed produce. So we'll come back to that a little bit later. The quantity variance, obviously it's the difference between the two quantities, actual and standard, multiplied by the standard price. So I like to refer to these as inside of the brackets or outside of the brackets. If it's the price variance, it's the price that's inside of the brackets, the difference between the two prices, which means the quantity must be outside of the brackets. With the quantity variance, it's the quantities inside of the brackets, actual and standard, multiplied by the price, which has to be outside of the variance, outside of the brackets. Now, outside of the brackets, one of them has to be actual, one has to be standard, and the way the model was first created, the quantity, which is in the price variance, is outside of the brackets for the price variance. That's the actual one. The price is standard. In the quantity variance, the price is standard. That's just the way that it works out. That's the way it was built. So let's take a look here at some of our information. And I've typed some of those in, but we're going to talk about it. Now this looks daunting. What I've done here, it seems like a crazy template. What it boils down to is, in the end, on the left-hand side, the C and E columns, this is what we need. What I'm basically doing here is, before we even get into the calculation of the variances, we're trying to find the individual pieces that we need for this problem. Some of them are given up in the problem, but others you have to calculate. So in different textbooks, they're going to give you one piece. You'll have to calculate a different piece, and they may change. So for each of them that could have either option, either it's given to you or you have to calculate it, I put the calculation over here, how we would derive that if we had to. Some of these will have to use these columns over G through L, but some of the information is already given to us. So you don't need to do the whole thing in most cases. We ultimately just need to find the number. So we're setting this up just to find the information before we get down to the actual variance calculations themselves. Now, of course, you don't have to draw a template like this when you're working the problem in a textbook. A lot of times you'll just go straight to this, but you have to show your work on how you calculated a certain item. So that's what the purpose of this is. So we need the actual price per square foot. And in this case, it gave us actual price. We actually purchased this at $1.30 per square foot. In some cases, what they'll tell you is that we purchased 143,000 square feet for this total amount of some dollar amount, and we have to back into how much we actually paid per square foot. But in this case, it's here. It's $1.30. If we did have to calculate it, we'd take the total price spent divided by the actual number of square feet purchased, and we'd back into this number. So that's what this template is for. Standard price per square foot, they generally give that to you. Here it says the standard for production is 7 square foot per unit, square feet. Oh, I'm sorry, we're looking at the standard price. Standard cost is $1.35. So before we even get any further, we'll come back to this later, but I want to mention here, we paid 30 cents less than expected. Our price variance when we get to it has to be favorable. We spent less money. Regardless of how many square feet we actually purchased, we spent 5 cents less, so our price variance has to be favorable. Less cost is favorable. Now let's take a look at the actual quantity of square feet needed to produce your current actual level of production. So we actually produced 20,000 units, and we want to know the actual quantity of square feet needed to produce the actual level of production. It tells us the actual quantity. We actually did use 143,000 square feet. Now, if they for some reason didn't tell us that, if they didn't give us that amount, then we'd take the actual square feet per unit multiplied by the actual number of units produced, and we get that same thing. But here they just gave us that dollar amount, so we're good to go. Now, the one that they generally have you calculate is the standard quantity of square feet needed to produce your current actual level of production. So the standard is 7 square feet per unit, but they don't give us a total standard, and in many cases they don't. 7 square feet per unit, we actually produced 20,000 units. So here's where we're finally going to use the right-hand side of this template. 7 square feet per unit standard multiplied by the 20,000 units actually produced. So our standard total amount should have been 140,000, which is what I'm going to plug in over here. Now, we should have used 140,000. We actually did use 143,000. So when we get to the quantity variance for materials, right away we know we used more materials than expected. Therefore, the cost is going to be higher. It's going to be an unfavorable variance. We'll come back to where we use these later on. We're just getting the individual pieces all in a row, so the next part is extremely easy when we get to the calculations themselves. Now we're on to labor. Actual price per hour. It says this required 400 direct labor hours that did cost $16 per hour, so they've given that to us. The standard price per hour, they tell us that, as well as a standard $15 per hour. So we didn't have to worry about separate calculations for that. Now we're down to the quantities again. Actual quantity of hours needed to produce your current actual level of production. So it says this production required 400 direct labor hours that cost $16 per hour. So 400. We used 400. We actually used 400. So for standard, the standard for labor is 0.028 direct labor hours per unit. We manufacture 20,000 units. So here, 0.028, which is rounding up, but we'll put it there, 0.028 times the 20,000 units. Make sure I got the amount right. Is 560 standard hours expected. So we used only 400. We used quite a few less than expected, so it should be a favorable quantity variance. Now we get to the variable overhead. Now, this is actual price per hour of overhead. Don't get that confused with labor. The quantity would be the same, but the price is going to be different. So here in this case, they tell us the variable overhead standard of $8 per hour, but they tell us that actual variable overhead was $4,100. So we need to figure out how much do we pay per hour of overhead. Now it's the same quantity as actual labor. We actually did use 400 direct labor hours. Whether we're talking direct labor or variable overhead, it's the same quantity. So if we spent $4,100 when we had 400 labor hours, this is actually actual number of hours, labor hours. Let me change that. Actual number of labor hours used, because that's how our variable overhead is being allocated. It's just this one that needs changed. So 4,100 divided by 400 is 1025. That's what we actually spent per hour for labor overhead. The standard price per hour is $8. The variable overhead standard is $8 per hour. They gave that to us. So we actually spent $10.25 when the standard was $8. We spent quite a bit more in variable overhead than expected, so we've got to have an unfavorable variable overhead variance, price variance. Now let's take a look at the quantity. Actual quantity of hours needed to produce your current actual level of production. The good news is we've already done that. We've already done both for labor. It's the same quantity of hours. They're the same hours we're using. It's just for a different purpose now. The price will be different, but the number of hours will be the same. And just to make sure everything is, we're all clear on where this is coming from, it's the same calculation as labor. So I'm bringing in this right-hand calculation as well to support this number. So this was materials, labor, and variable overhead. Now we have everything we need to calculate our actual variances. So we have the direct materials price variance. It's the actual price minus the standard price, and notice I have the brackets here, multiplied by the actual quantity. So I'm going to just link everything in to where we put it. Actual price per square foot minus standard price per square foot. And then our actual quantity that we used. And then here we have the actual calculation to do. Now, the other thing I want to mention here, variances are actually always positive as far as numbers. So what I'm doing here, even though you notice we came up with a negative, I'm going to put in an absolute value formula in here. It's just ABS in front of your entire formula. That way it always turns it positive. But that doesn't tell us, in and of itself, that doesn't tell us whether it's favorable or unfavorable. We have to take a look at, if we're just dealing with cost, more cost is unfavorable. We spent more than expected, it's unfavorable. Remember, our standard price was $1.35, but we only spent $1.30. We spent less per of the materials, so it's favorable. So don't look at the positive or negative in this variance. Take a look at, is actual less than standard or vice versa, and use that to determine whether it's a favorable variance or not. Now the quantity variance, we're going to, again, just use the same format, same method. We're going to link everything in. Actual price, $1.30. And I'm going to do the absolute value again. So the absolute value of the actual quantity minus the standard quantity multiplied by the actual price. So here we expected to use 140,000, but we used more, 143,000. So it's going to be an unfavorable variance. We used more square feet than expected. Now, by the way, with direct materials have a price and a quantity variance. So overall, if we take the 7150 minus the 3900, one's favorable, one's unfavorable. The higher one is favorable. So our overall direct materials variance is 3250. So we save more money by paying less per pound, even though we ended up using more pounds than expected. It's still favorable. It's still net favorable. So the direct labor variance, we're going to just link those cells again. The direct labor, the actual price, standard price, actual quantity of direct labor, and the variance is going to be the actual price minus the standard price multiplied by the actual quantity. So again, whether it's favorable or unfavorable, the only thing that matters is within the brackets. The outside of the brackets just tells you how big the variance is. Whether it's favorable or unfavorable is determined by the items within the brackets. We expected to pay $15, but we paid $16. We paid more. Therefore, it's an unfavorable variance. The quantity variance, I'm going to link the same way. Actual quantity of labor standard quantity of labor, actual price of labor. We'll do the calculation again. 400 minus 560 hours multiplied by the $16 actual price. So 2560 variance. We expected to use 560 hours. We only used 400. We used less. Therefore, it cost less. As such, it's a favorable variance. And now we get into the variable overhead variances. The price variance, I'm going to go back up here. Actual price. Standard price. Actual quantity, which is the same as the actual quantity from up above. So the actual quantity there is the 400 units. And it's the same as the actual quantity for the direct labor. So now the variance is, again, actual price minus standard price multiplied by actual quantity. So here, standard price was $8. We actually spent $10.25. We spent more. So it's going to be an unfavorable variable overhead variance. Now the quantity variance here. Again, we have the actual quantity, the standard quantity, the actual price, and our variance is going to be 400 minus 560 multiplied by 1025. So we use less than expected. It's going to be favorable. Now notice since in this particular situation, variable overhead is allocated based on the number of hours, just like direct labor, all of the signs are going to be the same way. The only difference, of course, will be the ultimate amounts because the price itself was different. But the signs, the direction, if you will be the same. So now, because this problem actually gave us the fixed overhead items, I'm going to spend some time talking about those as well. We have two variances under fixed. They are a different model than the other three that we've looked at. The first variance is called the cost variance, or sometimes the spending variance. So this actually is calculated by taking the actual fixed overhead minus the budgeted fixed overhead. The good news is this is as simple as one subtraction. Both numbers are usually given to you. We actually spent $3,900. We were budgeted at $4,200. Make sure I got the numbers right. $3,900. We budgeted for $4,200. So our variance is going to be $300, obviously. We actually spent less than budgeted, so we spent less cost. As such, it's favorable. That part is as simple as that. The next variance is a little bit trickier, but it's not too bad. It's known as the fixed overhead volume variance. Sometimes I like to refer to it as a capacity variance, or even a utilization variance. So different textbooks, different instructors refer to it as a different thing altogether. The calculation here is budgeted fixed overhead, which we already have. That's $4,200 from up above. But it's minus allocated fixed overhead. So let's talk about this for a second. Allocated fixed overhead. If we go back up here, they tell us that fixed overhead is applied on the basis of direct labor hours, very similar to variable overhead, calculated by dividing expected total overhead by the expected number of total direct labor hours. So budgeted total overhead, which was 4,200, budgeted number of direct labor hours, which we already have down below in our budgeted quantity of hours, 560. So they don't give us any other information. So 560 would be our budgeted quantity from, where do we see that here? Oops, up above. 560 is our standard quantity of hours. So 4,200 minus 560. Sorry, divided by 560. That gives us a rate of $7.50 per hour. So we take the $7.50 per hour multiplied by the actual quantity of hours that we used, which we have up here. That was 400. So 750 multiplied by 400 gives us $3,000 allocated. So we had budgeted 4,200, but we actually only allocated 300. So I'm going to do the same calculation, but then we need to talk about this for a second. So the variance is $1,200. Now the thing with this is a unique variance. And in fact, I will mention the different textbooks, different instructors, different people involved with this. Think of this a different way. There are three approaches you could possibly take. You could call this favorable, unfavorable, or neither. The thing is, this doesn't really mean you spent more money or spent less money. That doesn't mean that at all. There's no spending involved with this. It's how much have you allocated. The thing here is if you end up allocating more than what you budgeted, that basically means you got more out of your fixed equipment. You didn't pay any more. You just used them more to hopefully produce more units in general. So in my mind, and again about maybe over a third of the textbooks would say it this way, to me, allocating more than what you budgeted is a good thing. You got more out of that equipment. So that would be favorable. In this case, we allocated less than budgeted, so I would be inclined to call this unfavorable. We didn't spend any more money, but we didn't get as much out of our equipment as we otherwise could have. We still paid the full amount of money, but we didn't get as much out of it. So that's what it boils down to here. I would call this unfavorable. Again, some other text would call it neither, because it's really not controllable by cost reduction. The only one that's controllable by cost reduction would be the actual spending variance. This is just all about what volume are you operating at. So that takes us to the end of our variance analysis discussion. Hopefully this exercise has helped to clarify some things. Feel free to use this template if you're working problems, or at least refer to it to identify if they don't give you an amount, what would you have to do to calculate it. So I thank you for your time today, and have a good one. I will talk to you in the next section.